Good afternoon, everyone. Welcome back to the channel. We are joined by a special guest today, Erik Thompson of Peerless ETFs. So, Erik, thank you so much for joining. Do you want to go ahead and introduce yourself and tell us all about yourself and your company?
Yeah, absolutely. Thank you, Coach, for having me on. And my name is Erik Thompson. I am the co-manager of the Peerless Option Income Wheel ETF, which is a new fund that just launched 5 or 6 weeks ago. I'll give you some background on kind of why we launched it and how it's different and how it might have some advantages to some of the other things out there, and really just some education on, what we call the option wheel. And this is really what led me to this interview. When our fund went public, I said, you know what, I should just Google my own ticker and see what shows up. And the ticker's WEEL, WEEL. And you were one of the first to do a review on it. I'm not even sure if our website was live when you did it. But I said, okay, and it was a fair review. And we're looking for exposure as a new fund, and so I reached out, and I think that there's a lot of people, I'm learning this, that utilize options and are trying to hone their technique, and I think this is an opportunity to kind of provide the way that we do it. For background, I've been a retail financial advisor for my whole career.
Okay.
24 years now. Most of that time was spent with Wells Fargo advisors, helping clients plan their retirement, asset allocate, just make good financial decisions, kind of be their trusted coach. And I left there about 5 years ago, started my own registered investment advisory firm, fee only. It's called Peerless Wealth. And then that was about 5 years ago. And then throughout that 5 years, I had been, most of my career, for most of my clients, I've been kind of the Warren Buffett style of investing, just buy and hold good quality companies or ETFs. Don't try to, time markets, outguess markets. And that's I still believe that. But at the same time, with my own money and more for client money, I started to utilize conservative option strategies. And what I mean by that is the sell side. Okay, we're selling puts and we're selling calls. And it was really a way to, when interest rates bottomed out, I don't know, 4 years ago, and I had retirees that the 60-40 model where you had 40% in bonds, those things were paying 2%. And
Yeah.
I'm thinking to myself, that is dead money. Because if rates start ticking up, these things are going to start losing money. And even if rates don't move and stay low, it's only going to make 2. And that doesn't include anything I charge them, right? So I started utilizing some of the already out there like buffered ETF strategies and covered call strategies. And then I just started doing it myself. And what I started doing is I started to sell cash secured puts. First on individual stocks, then I did this mostly on my personal account. Then when I started doing it for clients, I focused entirely on ETFs, primarily sector ETFs. When you, as you guys know, whether you're using a covered call strategy or a cash secured put strategy, you have to be comfortable owning the underlying security.
Yes.
You can't get enticed by high option premium and then you get assigned the name and you're like, shit, I don't want this thing. It's a piece of junk, right? So you have to be kind of otherwise be willing to buy it. And if I'm utilizing individual stocks, and then I quickly learned, like, okay, I'm now assigned John Deere stock, but I haven't been on the earnings calls. I haven't been doing the research. And I'm not equipped for that. There's people at Fidelity and American Funds and Vanguard. They're not that individual investors can't do research, but I wanted this process to be about the option wheel, the actual wheel itself and the premium collection process. So I didn't want the risk of having an individual name get assigned and keep falling. And there's a ton of examples.
Oh, yeah. I've had it happen
Walgreens.
myself.
Yeah.
Yeah.
When we started this, Rob and I, we were doing it on some individual names, and we had Walgreens in there. It's like, okay, well, every time you go to Walgreens, you go in there for 2 things and you wind up buying 8 things and spending $80, right? Nothing can go wrong with Walgreens. Well, they went from like $80 to $20, and it's Walgreens. And it's like, so what we started to do is just do it on sector ETFs. And I'll go into a little bit more of that in a little bit of detail in a minute. But we quickly learned, and it made the most sense to us to do this weekly. It's a lot of work. However, from a risk return standpoint, we can write an out of the money put with a good buffer for the week. If we go out 2 weeks, we're not getting double the premium for that.
Right.
We might get 30 or 40% more premium, but now we have 2 more weeks. It could go down a lot more in 2 weeks than 1 week. So we like 1 weeks, but I can't go through every one of my clients manually every Monday morning and renew 12 positions, which is how we're fully allocated. I was doing about 10 clients, and it was taking me like 2 to 3 hours every Monday morning.
Wow.
And the client that I did the trade for at 9:45 is getting a different price than the last client that I did the trade for at 11:30. So I'm like, I need to package this. I need to trade one portfolio. And my partner Rob, who's an engineer by trade, used to design and troubleshoot power plants for a living. So it's more option experience than I have. But so we let's create an ETF. And so we did it for 2 reasons. Number one, really 3. Number one, we believe in the strategy. It was working, this WEEL strategy, which I'll go through the mechanics of in a minute. So it was working. Number 2, I wanted to scale my business, right? So I can just trade one account instead of have to spend hours, every Monday morning and having clients getting different prices. And number 3, if we can grow this, obviously the entrepreneur in me, if it's good enough for me, maybe it's good enough for others to use. And it hadn't been done. There's no 40 Act. When I say 40 Act, ETFs and mutual funds, publicly traded vehicles. There's no 40 Act fund that utilizes the WEEL strategy that I know of. And I've done a lot of research on this. And there's a ton of covered call strategies. There's a small amount of cash secured put strategies. But really the essence of the WEEL is you pick a security. And I have an example because I just did this yesterday. OIH, which is the oil services sector. Okay.
I'll pull it up.
Yep. About $307 a share. Consists of companies like Halliburton, Schlumberger, Transocean.
You said OIA?
OIH.
OIH. Okay.
I'm in Ohio, so I figured I'd pick that one and
it's close.
Maybe get a Go Bucks.
Right.
So now we're doing this on about 10 or 12 sector ETFs. We are not trying to pick the better sectors. Okay. What we're doing is trying to pick apart the S&P 500, but get higher option premiums by doing sectors instead of just doing it on SPY. Does that make sense?
Yeah.
It would be a lot easier just to do it on SPY, but we would not get the premiums. There's more risk in one sector than the whole index. Therefore, we get more option premium. But as a portfolio, it's still diversified because we're owning just about everything. Or we're writing options on notionally. We're exposed to just about everything. Now we're skipping over consumer staples, utilities, and REITs because there's just not enough volatility in there to create any sort of good option premiums. But it's the exposure is very similar to maybe an equal weighted S&P index. We do some small caps in there too. So we'll write a put Monday morning on OIH. Maybe we'll get 80 cents for it. Okay, and that's weekly. Well, 80 cents on one contract is $80 on 100 shares. So we're going to get $80. It's 307. We're going to write the 297.50 put. Okay, so we're giving it a 10-point cushion for the week. Okay, so these are out of the money. Think of that 10-point as your loss buffer. OIH can drop 10 points. I don't lose a dime, and I keep all my premium.
What strikes are you going for?
So in the example OIH, it's trading
Mhm.
about 307. I'm doing
Yep.
the 297.50.
Okay. How far out?
1 week.
Okay. So like for this week, you would be doing like July 19th?
The 12th.
12th. Okay.
Yeah.
Okay.
And I think yesterday I got about 80 cents for that
hmm
because it's Monday morning. So we got $80. So here's the math we do on that. We take the 80. Now they're cash secured, right? So we have to have enough in our cash, our brokerage account. Now we use T-bills. We have to have enough in T-bills to buy OIH should it get to 297.50 or below. That's cash secured. We're not doing naked put writing. That's aggressive. That means we got to go find the money from another source, and that's what we don't do.
hmm
So they're all secured by T-bills. No, so I got to have minimum option contract is one. That's 100 shares. So I got to have $29,750 ready to go in case that fills.
hmm
Now, it probably won't because it's 10 points out of the money. In fact, option math, we use deltas of about 20, says that there's an 80% chance that this won't get assigned. And we'll just
Okay.
keep our premium and we will rinse and repeat and do this every week. And if we do that, that $80 we get times 50 weeks, I throw 2 weeks out because of holidays and all that. So I multiply 80 times 50 and I get 4,000. If we did that every week, we'd get $4,000. I have to put up $29,750 in collateral. $4,000 on $29,750 is a 14.3% return.
Yeah.
In addition to that, we're getting about 4.5% on our T-bills. Okay, so we're pushing 20%. That's probably going to be about the most we'd make also. There's really no way in this trade to make more than that.
hmm
Okay, so this strategy will lag in a roaring bull market.
Yep.
Because the most you're going to make, it's covered calls, similar, right? So okay, that's the cash secured put. If it stays flat, it can go down a little bit. We're going to make that premium. We're not going to get assigned the name. Now, eventually, OIH and every other sector that we write these options on, it's going to correct, right? We're going to get a bear market. We're going to get some of these, all of these. So if OIH drops and finishes at 295 for the week, we got to buy it at 297.50. We're showing an unrealized capital loss of $2.50. Now we got our 80 cent option premium, so that partially offsets it. So here's where the wheel comes in. Monday morning, we got 100 shares of OIH, 295. We're down $2.50. We hold it. And then we write a call, so it's covered. We write a call and we pick the strike price, usually at what we got assigned the shares, the 297.50. So effectively, so we're going to get another dollar, maybe $1.50 for that call. There's our second stream of income, right? First stream was the put premium. Second stream was call premium. And it could rebound the very next week and get called away, which happens. It could go down more, right? And we would just keep writing calls, but we always set the strike back up to where we get back to even.
hmm
Even if we have to go out a little longer, even if the premium sucks, we don't want to get called away early. I think that's a huge problem with a lot of the covered call strategies out there. You have 100% of the downside, which we don't because we have a buffer on the first few percent, but you have 100% of the downside And then by prospectus, they have to keep distributing yield. So they have to write calls, keep writing calls in a bear market. The only way to get any call premium is to write a strike price that doesn't give it a lot of room to rebound. And in bear, the biggest gains in the market usually come after bear markets or right at the end of bear markets. And we don't want to get called away early for that. We don't want our NAV to go down over time. And if we wait till it comes back to even, and we could be waiting a while, right? Then that's not going to happen. So eventually, because it's a sector, not an individual stock, I probably couldn't say this about an individual stock, but eventually the sector will rebound.
Yeah.
And then it'll hit its call price. It'll get called away. We've got our money back, and we've got now 3 sets of maybe even 4 sets of income: our put premium, our call premium, our interest income on our T-bills, and maybe a little bit of dividend income while we own the underlying ETF. So, 3 to 4 streams of income. It gets called away. We're back to cash. We're back at that top of the wheel, and we simply start the process over again.
Mm-hmm.
And we've been running this strategy for clients. We had a CPA firm audit our returns. There's rules on what returns I'm allowed to say when I'm talking about the ETF, when it's not the ETF.
Yep.
But I can say it keeps up pretty well in a bull market. It loses a lot less during a bear market. It'll lose some because the underlying, can come down. But we reset those buffers every week. So we could lose a little bit every week in price, but the fund doesn't lose because we reset every week.
Yep.
So that's kind of the essence of the fund. It's designed as a core alternative income, a core derivative income. And the last important thing I'll end this part with is we believe it's the best solution for a flat or range bound type of market scenario. When I allocate my client portfolios, if it's a retiree, I might put 50% in equities, 30% in fixed income, and 20% in this.
Okay.
That's kind of how I'm doing it, maybe 10% in this. I'm not predicting a flat market or a lost decade, even though there's people that do. I'm just saying you probably should have a piece of your portfolio that gets a respectable return into the double digits if markets aren't doing anything. We don't need share prices to go up for this to make money.
Right. No, I like it. So whether you realize it or not, you picked a great audience to come to, because we have a lot of people doing the wheel strategy in this audience. And so we do have some questions for you.
Yeah.
So I'll go ahead and start off. So this fund has been around since what, May? So it's like almost 3 months old?
2 months.
Okay.
Not even 2 months. May 17th was the launch date.
Okay.
And again, the ticker's new, but myself and my partner have been doing this manually for clients for a while.
Yeah. And this is your first fund that you have put out?
Yeah.
And so far, it's your only one, right?
Yeah, so far.
Okay. Okay. And I'm sure, like all ETF companies, you have more in the works.
Not a specific one yet, a few ideas floating. But here's the thing.
Mm-hmm.
If you asked me 5 years ago if I'd ever start an ETF, I would have probably said 100% no, because I always thought that space was, kind of reserved for the Vanguards, the Fidelities, and I thought all the good ideas have been taken. Like, what am I going to do? Start another large cap value ETF or dividend ETF and try to put some slightly different spin on the other 100 funds that are basically the same thing out there and get into a cost war? No, but this was truly different. We actually have a patent pending on the fact that we're the only fund that has the wheel as its main investment component. I don't know if we'll get the patent, but it is filed. The other thing about it is you'd have to have probably $300,000 or $400,000 in capital to diversify the way we're diversifying. Just in my OIH example, I needed $29,750 for a minimum of one contract, right? So now multiply that times 10 positions. Here's the problem people get into when they do the wheel on their own. If you don't have a lot of capital, you're forced to a shorter list of names, a lot of times individual stocks, that have $10 and $20 share prices.
Mm-hmm.
And because, the minimum is one, that means if it's a $20 name, you got to have $2,000 in collateral if you're doing cash secured. If you want to diversify, then, so then you're forced into writing options on a lot of times names that are kind of aggressive and speculative and could maybe blow up a little bit on you. So far, this is our first fund. We, we could, I think if we do other ones, it'll still incorporate the wheel. Maybe we'll use go for higher premiums and tighter buffers. Maybe we'll include individual stocks. I don't know, but so far none. And we're the sub-advisor. So Title ETFs is the advisor.
Same as YieldMax.
Yeah, so they're the advisor with YieldMax. So I think that's important to note too. I realize we're a small shop, and we realize that we don't have the infrastructure for legal compliance, prospectus, board of directors, trading, market making, website. Title helps us with all that.
Okay.
So that we can stay regulatory, above board, and we can, and they do they kind of basically package everything to where we just have to worry about, trading our portfolio.
Right. Very interesting. So would you say, because we do have people in this audience that are doing the wheel strategy themselves and doing quite well, would you say a fund like this could replace someone like doing their own wheel strategy if they were to invest, say, like 100,000 in this fund?
Yeah, I think that it definitely could.
Mm-hmm.
I think that this is going to be more conservative than, I'm just guessing here, but more conservative than a lot of your listeners might be used to. I see a lot of stuff on YieldMax on your on your previous stuff that you've done, and congrats to them. They've really raised a ton of money. Don't get too enamored with yield, because you just have to assume you're going to wind up with the underlying. And if you wind up with, in our fund, if we get a bear market and you wind up with 10 sector ETFs, it's basically like owning an S&P 500 fund. You're not going to get cremated, right? I mean, you're not. It's going to come back, and so it's going to be a more sustainable strategy than doing single stock ETFs. You certainly could do better doing single stock ETFs on your own, but if you want something that is more sustainable, hands off, and you don't want to have, you don't have the capital to diversify, don't do the wheel if you're not diversified, right? I think you need to, just like anything else, I think you need to own write options on a lot of names. If you can't, sure, own a fund. It's a lot less work.
For sure. And that's definitely what a lot of people are looking for. And we certainly do have, I'd say the bulk of the audience is high yield chasers. I consistently point out that most of the underlyings do better. So me personally, like, I would rather be in the underlying in a lot of cases.
Yeah.
I don't mind, actually. I call it the dividend wheel, getting the dividend and then buying the underlying with the dividend. Yeah, I do preach that a lot on here.
I think that the last few years we've been in last couple of years anyway, we've been in a bull market. And so the underlyings are almost always going to do better than when you're writing options on them. But it's that flat or do nothing market, which we could be in for the next few years. You don't know. That's where this income's really going to start adding up and be comparatively better to owning it long.
Yep. Interesting. Okay, here's a question. Does the WEEL ETF have enough upside growth for young investors?
I think it does. Time will tell. Obviously, we can't promise anything, but if we look at the way we're writing these premiums, we're shooting for, on the put side, top of the wheel, we're shooting for premiums that annualize in the mid-teens. Now we're getting a little less than that now because volatility is really low and premiums flat out suck right now. But I don't believe low vol is here to stay. We'll get something that spices things up, and we'll get more in the high teens, and we'll get a few percent on our cash. We probably won't do much more than about 20% in a year. So you're like last year where the S&P made 25, 26%. In a strategy like this, you're going to do well, but you're not going to keep up with it. So I think, except in a roaring bull market, in a moderate bull, we'll probably kind of do roughly what the S&P does, maybe with a little less volatility because we're getting it through income. Flat market, it's good. It doesn't really matter your age. You want to hedge against various types of markets. And
Yep.
if without going into I know yields are higher, but we're gonna, I can't say we will. We aim to do a lot better than a 4 or 5% money market account. So if you want something that's better than that in a flat market or a weaker market, but you don't want to go all in on the volatility of like the S&P, this fits.
Yeah. Awesome. Yeah, we interviewed another fund last week that I think it was like a 2% dividend. And it had a decent return over like 2 years, but outperforming money markets is a good thing.
Yeah.
Yeah.
Yeah. At least we're getting a fair rate of return these days on our short-term cash. I mean, everyone needs their emergency fund.
True. Well, my whole thesis, you have like real return and then nominal return, like with inflation
Yeah.
and stuff. Yeah, we're getting a higher nominal return, but it's still kind of getting eaten away by inflation.
Well, and one of the things, again, no other fund is doing the wheel. Very few are doing cash secured puts. However, I think more should now because interest rates are higher. Back 5 years, you had to have your cash collateral. You weren't getting any return on that. Now you're getting the put premium, but you're also getting another 4 or 5% on your cash collateral. So cash secured put writing should be a bit more attractive in a higher interest rate environment.
Yeah. Yep. Okay, let's see. We have a fan here. Love the concept. Purchased 100 shares. Kind of wish monthly
Yeah.
payments instead of quarterly.
First off, thank you for the purchase. We're getting this off the ground, and it's really fun to see and gratifying to see other people buy it. And so thank you. So here's I figured this would come up. We're going quarterly, and the reason why is because we are almost convinced that the shareholder will receive more yield throughout the whole year if we do 4 quarterly payments instead of 12 regular payments or 12 monthly.
Okay.
It's because we're writing weeklies, right? So if we need to pay a monthly dividend, we probably have to be in cash with no option overlay against it. Probably not 1 day, but 2 or 3 to make sure with settlement and everything, there's time to get the dividend out. So if we got to be sort of uninvested for 2 or 3 days out of 30, and really 20, because the weekends are, so it's even 2 days out of 20, that could mean over time, 10% less option premium, right? And so it could turn a 10% dividend to a 9% dividend. And, so I think that there's administrative costs to paying monthly, including the cost of being having that cash available and having it not be utilized to create option income. And on that note, because we just launched in mid-May, we didn't have a whole quarter there, so we're not going to pay a June 30th dividend. It would have had to be a partial dividend, and it would have understated what the yield will likely be. So we're waiting till the end of September, and it'll be a whole quarter plus a little extra dividend, and then quarterly from there on out.
Yeah, that makes sense. Someone says I've been wheeling yen. It's an options cash cow. What is the time frame for the options?
Gosh, I haven't. Let me look up. I don't know what yen is. Hold on. Yen is okay. 3x China bull.
Yep.
So you're wheeling an option strategy. You just have to be comfortable with getting assigned the China index and losing 3 times what it actually would lose. Right?
Yep.
Because that's a
Yep.
3x multiplier. I'm sure the premiums are sexy, but every time you do this, you got to be willing to buy a leveraged China fund, because at some point you will get assigned. So
Yep.
that would be so the closest thing we do to that is KWeb. I think we have about a 4 or 5% notional position. And when I say notional, when we're writing a secured put, we don't actually own the underlying, but we have, if we got assigned, it would be a 4% exposure. So it's not exposed yet, but so we have about a 4%, maybe 5% on KWeb, which is Chinese internet. So it's your Alibaba, your Tencent, and you know, those are arguably undervalued names compared to the U.S. I think there's reasons why China is cheaper than the U.S. Government, manipulation, potential manipulation, other reasons. But the option premiums are good, and we can have big buffers on the week for loss. But we would almost never. I can't think of a time we would go into a 2 or 3x levered ETF and write options on that. We don't lever the fund at all. It's all cash secured, and it's all selling. So we're not buying puts, we're not buying calls. That'd be a risky one.
Mm-hmm.
That's as a licensed advisor telling you that'd be a risky one.
Oh yeah. And I think you answered this one already, but it's a weekly time frame on the options.
Yeah. And we just get more bang for the buck on that. I think we can get, we don't get double the option premium by going out 2 weeks, and we don't get quadruple by going out a month. Mm-hmm. So we would rather reset our cushion every week, which protects us if markets are dropping. This is it's kind of a combination between like a buffered ETF, if you're familiar with those, you protect it on the first chunk of losses, and then a covered call fund. So there's an element of risk control here that it's going to be, at least our goal is to be more conservative than the typical covered call fund, because you're buffered on that first chunk of loss.
Right. Okay, let's see. I don't know if you can answer this one. You said it was going to be September, but you did say quarterly, but we're probably not going to be able to estimate.
Yeah. So our current estimate is September 30th, paid, shortly after that, probably within a week after that. We are in the process of having a Q&A or a FAQ section to our website.
Oh, perfect.
So it's getting approved right now by the title compliance people, but it'll be out probably within certainly the next week. But good question.
Yeah. I'll go ahead and put the website up here for the audience. So we have a few more. Let's see. Peerless merchandise. Any merchandise?
We did just order. They're like stress balls, but they're in the form of a wheel. Mm-hmm. And I don't think we have them yet, but I got to get this thing. We got to get this thing up and running and get a good history and good assets, and and I anticipate all of that, but we haven't ordered any merch yet.
Yeah, no, it makes sense. Focus on the important stuff first.
Yeah.
Right. Yeah. I like the website. Good web designer, obviously. Let's see here.
That's my favorite statistic right there, Coach.
Yeah.
So that statistic says this is the last 100 years of calendar year S&P 500 returns. Mm-hmm. So the right purple bar chart, 49% of the time, the S&P made greater than 15% for the year.
Yep.
That's why we own stocks for the long haul. We get a lot of bull markets. That's why you set it and forget it on a S&P index or a group of large cap stocks. Far left, what is that? 19% frequency. The S&P loses more than -8. That's your correction, bear market. That's when you just gotta, have time on your side, bear down. Retirees, maybe they need bonds. That middle column is when the S&P is between -8 and +15. That happens nearly a third of the time. That's where we believe we can outperform both equities and fixed income, the typical equity fund like the S&P, the typical bond fund, because we're going to be, remember, we're writing premium that equates to 15-20%. And you know, if the S&P loses, we may offset that with that premium. So we believe that that's kind of our market. And the analogy I'll give is I have a 9-year-old that plays a little league, and the games are fun. But anyway, let's assume for a second that, you know, the coach did an analysis of the whole season, and he found out that 32% of the time the hits went to either center field or left field. And then he decided not to put any outfielders over there. That wouldn't be very smart, right?
No.
Right. So we're not guessing where the ball's going to go. We're saying, hey, you might want to plan for a flat or a range bound market or slightly up. And then that's where these option writing strategies can really, and covered calls, you could, you know, argue that too. But, you know, I have well over 10 years before I need my retirement money. And this is a big part of my portfolio, because I just, you know, the S&P 500 is 25 times earnings right now. The historical average is 16. You know, the government has, their debt service is now 20% of GDP instead of 10. You know, things could slow a little bit. And you want to have some strategies that are providing you that income.
For sure. Yeah. So you're getting good feedback from the audience. We've got other channels on here too. Let's see. Said you raised a lot of money. I think we have a couple more. Let's see here. He says, I'm interested in buying this as a hedge. Does most of the premium go to the distribution back into the fund?
Okay. Very good question. So there's rules for a 40 Act fund. And the rules are that by the end of the year, we have to distribute all income and interest. Option premium is considered income. Interest on our T-bills is considered interest, and dividends if we own any of the underlying. So we have to distribute it all. We don't know yet what the dividend's going to be. I'm not allowed to say. I just checked on that. It will be a yield-oriented strategy. It won't be the high yield max type of numbers. It's $20 a share. What's likely to happen, or our goal, most quarters without any big negative downturns, you'll see the $20 kind of inch up and up and up, and then we'll pay our dividend. It'll go back down to 20, right? It'll go up and up and up, and we may pay an extra one toward the fourth quarter because we have to get rid of any excess we haven't paid. So we have to pay it out. This thing will not trend up. The $20, it will not go up over time, because remember what we're doing. We're getting assigned, and then we're just waiting for it to get back to even. So there is zero capital gains in this fund. And that sounds bad, but if there's enough option income, it doesn't matter. So that's option income, and interest income is going to be the vast majority of the returns. If you don't need it, I'd reinvest it and build shares.
Yeah. How about this one? Do you expect to outperform during flat markets?
Yes, I do.
Yeah. Awesome.
If you want to say hedge, this isn't a bear market hedge. Okay. If you want to do that, you buy puts. We're not doing that. There's more bull markets than bear markets. I think that's a timing option. I don't like it. Yeah. Hedging against flat or range bound or slightly up or slightly down. That's what we're about.
Okay. How about, do you roll or take assignment?
We always take assignment.
Yep.
And then we hold it. Yeah. Until it comes back.
So we'll do one more question. How about a DGen WEEL ETF for wheeling stocks with high IVs only?
So I actually appreciate that strategy. I think that one of the things we've tried to do by breaking apart the S&P, if you wheel SPY, it's kind of, there's just not enough premium there. So we've tried to take out the more aggressive components. Again, we're not putting utilities and REITs because it's just kind of pointless to do. So that's why we got ARK in there as a holding, because there's some nice premium in there because the underlyings are Tesla and Coinbase and so forth. I would, yeah, I think that's kind of in the back of my mind. That's kind of how I started the WEEL process with names like Tesla, high volatility ones. But what you want to do, and we've done a bit of this in WEEL. So we have about 10% between XLE and OIH, which is essentially energy and oil.
Yep.
That's way more than the S&P. S&P is like 3%. But those two names have a correlation, a beta of like 0.3 to the S&P. KWeb, the Chinese internet, has a beta of like between 0.3 and 0.4 to the S&P. So they're aggressive in and of themselves because they're a sector, but they're not moving in lockstep with everything else. So we really like those. To answer the question, if I could put a group of names together that were high volatility but didn't move together, that's the key, right? So I could find 6 tech stocks that were all high volatility, but they're all in the same sector, so they're pretty much going to go up and down, the same. Not exactly, of course, but the really good question. That maybe that's on our to-do list for the second ETF, but they have to be not correlated or not highly correlated, so they don't all go down at once.
Mm-hmm. Awesome. Well, great discussion. We'll definitely have you back on with your other business partner, and we'll have you on the podcast soon too.
Yeah, I'd be happy to.
Yeah. So thanks for coming on again, and great questions, great discussion. I'm going to go ahead and end it there. So any final words to the audience?
No, I appreciate you being on. We do have on our website, I think there's an info at email, and we have been getting a few questions here and there. So feel free to ask any follow up, and it'll be me or Rob that'll answer it.
Awesome. Sounds good. All right, everyone.
Okay.
Thank you for tuning in. Like, comment, and subscribe, and join Discord. We will see you all in the next one. Take care. Bye.